Thank you for the warm welcome, and I am indeed honored to be here. I would love to share my experiences with you. In the past about 2 decades, whatever I've learned in the banking field, in the how it has evolved, and how technology is playing its part in the evolution. That's what the key theme is. But before we start, I'd love to know from you your expectations from the session. And of course, let's start with history, how world has evolved. That's the first part, because till the time you know what was there, you won't be able to predict where we'll go. So I'll start with, as I was giving the example to Sir 20 years back, 2004 is when I joined ICICI Bank. So when I went to my first client and got my first file, I got 400 pages printed. His bank statements, his income tax records, his KYC, his address proof, electricity bill, so on and so forth, his loan statements. Got him to sign on all 400 pages, self-attestation and authentication. And then, along with the application form, the file was given to the bank for initiating the approval process. Going to the client, printing 400 pages, getting signed, getting it back to the bank took me a full day. So it was one full day gone, and that is when the file processing started. Once the file processing started, there was a team of CPS, we used to say processing agents, who actually physically opened the bank statement, who tracked down what the monthly credits were. So they had an Excel sheet which said January credit of 2 lakh rupees, February credit of 2.5, March credit of 1.5. They tracked it for 12 months. Similarly, they tracked the balances on 15th and 30th of every month for the last 12 months and calculated average balances out of it. This was a manual process for banking. Then they opened the financials. They input all the data of P&L and balance sheet in a preset format, which again gave them certain ratios. So they manually input all the data. Then all this data along with the Excel sheet, they made a note, approval note as we said, which was a 5-line, 6-line note with predefined 7, 8, 10 criterias. They made the note. Then that note, that Word document along with the Excel calculations, whatever they've done, was sent to the credit manager for his approval or rejection or further processing. So this took another 2 days. Okay, this was what happened in 2004. Today, suppose I am still the same sales manager, I have not grown in my career. If I go to a client today, I'll sit in front of him. I will tell the client, my bank will be sending you 3 links. You please click those links, put in passwords, and I'll fetch data. I'm sitting in front of the client having a cup of coffee. First link goes to the client, Aadhaar-based OTP verification and KYC verification. So what the client does, clicks on the link, puts in his Aadhaar number, an OTP comes, puts in OTP, and all the KYC is done. Time taken, 2 minutes. Second link goes, client then clicks the link, puts in his income tax login ID and password. All the financial data is fetched. Already, since it's all standard data, it's all bank systems already fetch the requisite data in the proposal directly from that link. No manual intervention. No credit analyst, processing analyst role. Third link is the bank statement. So again, same. Client logs in, puts in his internet banking login ID, passwords. Bank fetches the data. So now, all this is happening while I'm having 1 cup of coffee, which is exactly 7-10 minutes. The data collection is done. The data feeding part is done because it's all driven by technology these days. So that is the evolution, which used to take 3 days, 4 days before, depending on how many files have come in, happens in 10 minutes today. What used to take me, then a credit manager, then 2-3 people in the processing agency, then travel, is all gone. It's all, I'm sitting there in front of the client and this all is done. Right? So earlier an approval process, getting a file to getting it approved, was 5 days minimum. Today it is 5 hours. Why? Because data is picked up, put in format, results given in 10 minutes. Then all the credit manager has to do is to look at them, figure out whether the loan can be done or not, approval can be done or not. So that is the evolution of finance in lending space. Let's talk about account opening. Today, I'm sure a lot of you would have opened digital accounts. What does it take you? Nothing. An Aadhaar OTP? Done. Right? Let's talk about transfers, fund transfers. Everybody today uses GPay and PhonePe and all those apps, right? When we were there, we were literally, yaar, 10 rupees ka chutta hai, nahi hai, de de. You know, that was the situation then. When we were there, even ATMs were a novelty. 2003 is when ATMs really started getting mainstream. Metros mein the, bahar nahi the. Securities markets, stock exchanges. Earlier, there used to be manual trading. ICICI Direct revolutionized it in 2003 through its online portal. Right? And then today, you have everything on your app. You don't even need a computer. So this is how banking has evolved in technology over a period of time. What used to take hours and days and weeks is now minutes and hours. So the data collection and processing has really evolved. A lot of decision making, credit decision making. For example, there were template-based products like car loans. Certain income, you are approved for a 10 lakh ka car loan, 12 lakh, 15 lakh ka car loan. A lot of these template-based products, the decision making is also automated. So a car loan approval literally can be had while I finish a second copy, the approval will come to the client digitally, a sanction letter. This is what the evolution is happening. But those approvals, the car loan approvals are a simple go, no-go criteria. It has got no thinking as such. If X happens, then Y will be approved. Simple. So this is the evolution of technology in banking, how it has evolved from 2004 till now. Where will it go from here? Is a much larger question which even I'm not aware, I'm not sure. But it's surely, moving ahead very fast. So banking, stock markets, technology has changed. Now what has changed for the corporates? I'm a company, I'm a businessman doing business. What has changed for me? For me, what has changed is 2 things. First, my IT filing and all was manual. If you remember earlier days, you will not remember, your fathers will probably, your parents will probably remember. Your ITR, you used to go to the IT office, submit an ITR, get a stamp received and then come back. And then 3 years later, you will get a notice saying that your ITR is defective, please pay more tax, dispute, give information. Today, ITRs are digital. As a businessman, for filing my ITR, I don't need to go anywhere. I'll sit at home in my computer and file my ITR. Similarly, my GST returns. So every transaction of mine today is digital, and the ease of business, I believe, has gone up multifold. The chances of companies doing financial irregularities in terms of forging their sales or forging their EA has gone down dramatically. There's still loopholes. It is not, absolutely foolproof, but they've gone down a lot. So even for corporates, the interaction with the government departments has gone down dramatically due to digitalization of those services. Okay. Similarly, for a corporate, when it goes for a bank loan, I just explained it from a bank's perspective. Imagine from a customer's perspective. He used to get that loan in 10 days. Now he's getting it in 10 hours. or 2 days, whatever the time frame. But so that is from a customer's perspective also, and that too faceless. No signing, nothing. All OTPs, all digital. Even the agreement execution. If I am taking a loan from a bank, the agreement execution today is digital. There are no longer lengthy agreements to be signed, to be stamped. Earlier we used to pay stamp duty to the government by going to designated bank branches. No longer. Digital. If I talk about consumer, you and me as a consumer, all are, let's say, we go and buy a property, right? Or we rent out a property. We have a property, we want to rent it out. The leave-in license agreement is digital. Even your purchase agreements, you have to upload it on the site beforehand. They will check it beforehand, and you just have to go and put your thumbprints. Very soon, that will also be digital. From the ease of your home, you can buy and sell the property. You don't have to visit the registrar office also. That will happen very soon. So that is the evolution of technology, and that is how finance has evolved along with it, from a consumer perspective, from a corporate perspective, from a bank's perspective, from an insurance company's perspective, and from a lender's perspective. Okay. Let's move on to forecasting. Now, I'm taking forecasting from 3 perspectives. First is the company perspective. I'm a businessman. I am running the business for 5, 7, 10 years. I'm applying for a loan, and the bank wants to know how much banks want to forecast my business. Let's start with that. How do you think this forecasting happens? Exactly. Pardon me? Based on historical data. Okay. Now, let me give you a banker's perspective on how we forecast revenues. First thing we ask is, यार ये किस business में है? अगर एक bakery है, for example, a bakery has a limited crowd it can cater to, maybe a 2-kilometer radius around it. A bakery normally does not cater to a client living 10 kilometers away from it, right? So limited crowd, limited avenue of growth, right? So that crowd in 2 kilometers will have only so many birthdays. And if a bakery is opened this year right next to you, your business will go down because he will eat into your business, right? So first question, what kind of business am I in? Right? What kind of market potential is there? If I am into online selling, right? Then my market is immense. मैं कपड़े बेच रहा हूँ, मैं लड़कियों के कपड़े बेच रहा हूँ, right? I'm selling clothes for girls. Immense market. Each girl will have same t-shirt and 5 colors, right? Right? So first is what business am I in? Second is what market size is possible. Third, what are my capacities? If I'm into trading, my capacities is immense. I can buy as much stock and sell as much stock. My capacity is only limited with my storage space, warehousing space, which I can take on rent again. But if I'm into manufacturing, my factory can run only for 24 hours a day. And 24 hours a day means a certain amount of production. It cannot go beyond. So third is, what is my capacity? Right? Fourth, as you all said, how have I been growing historically? If I'm growing 10% historically, then the chances are bright that I will grow at 10% only, subject to these constraints. These are called constraints, right? Fifth, what am I as a business doing more to grow more? There are businesses which are actually actively marketing, which are actively expanding their capacities, which are expanding their market portfolio, who's in domestic market is wanting to go into exports. So until unless you understand that, what is the business doing to expand its business revenues, right? This is the fifth point. And there is one more sixth point, which is whatever items am I selling, what kind of price increments am I getting there? If I'm selling only 100 pieces a year, for example, each piece sells for 100 rupees. My annual revenue is 10,000 rupees. Next year, the selling price goes from 100 to 110. What happens? My revenue grows from 10,000 to 11,000 because of inflation. When we do projections, and we are talking about only revenues at this point, there are these 6 factors which I look at. There can be a 7th, 8th, 9th factor also. 7th factor can be, how is technology making you obsolete? Earlier there were PCO booths everywhere. Today do you find PCO booths? No. Why? Because technology has made you redundant. So that is the 7th factor. So there can be 3, 4, 5 more factors like this depending on the business. So whenever you do projections, right, the first thing is any kind of projection you do has to be supported by your thought process behind it, by your assumptions behind it. And assumptions cannot be historically I'm growing at 30%, I'll keep growing at 30%. Never works. That's where a lot of us do mistakes. Now, the same thing is applicable whether a bank is wanting to lend you or whether you as an investor are wanting to invest in a stock. When you invest in a stock, you do some DCF, you do some future projections, right? The company will keep growing. How will it keep growing? Is it putting up a factory? Is it exploring new markets? So this is how you do projections. The second part of this is projecting costs. Cost of goods sold. Let's only talk about that. How do you project it? So the baseline, of course, is the assumed revenue. If my assumed about quantity at this point, right? If my sales is going up only because of price increments, then my goods consumed will not go up in numbers as such. So let's talk about, now I'm done with projections. So I know approximate quantity and the value both, right? So first thing is obviously link it to the increased production quantities. Second thing, as they said, the trend in raw material prices. What is the historical trend in steel prices? Steel is my raw material. What is the historical trend in electricity prices? Production के लिए मेरे को electricity लगती है, right? So this is the second part to consider. Third part to consider is what kind of initiatives the company is taking for saving costs. When I'm doing a business, every year I want to save money. To save electricity, I might decide to put up a solar plant. So my electricity expense, which was 1% before of sales, might go down to 0.5% because I've put up a solar plant. Right? My cost will actually go down. Right? Another thing to consider. If I'm buying 100 items of a raw material last year and I'm going to buy 200 this year, can I get volume discounts? Right? So my cost, which was 100 rupees earlier, can it become 98? Possible, right? Another thing to consider. If my capacity utilization last year was 40% or 50%, I'm simply increasing production, will my labor cost increase? Will it increase in proportion of sales? Mostly not. So whenever my sales go up, my production goes up, my labor cost does not increase in proportion to sales. Because my repair person, electrical जो मेरा एक repair person है, वो एक ही है पूरे factory का. मैं 100 प्रोड्यूस करूँ या 150 प्रोड्यूस करूँ, वो एक ही रहेगा. सिमिलरली मेरा सुपरवाइजर एक ही रहेगा, भले ही वो 15 को सुपरवाइज करे या 10 को करे. It will not change. So my production cost in terms of labor, as I increase volumes, goes down. So when I project my cost of goods sold, I have to consider all this in my calculations and in my thought process. So that is how I get my cost of goods sold. Similar exercise is to be done for your indirect expenses. When I say indirect, your management salaries, your office salaries, your transportation, everything else. And that certainly doesn't go up in proportion to your cost. All right? So this is how you do projections. So that is about forecasting. Once you forecast your profit and loss account, a balance sheet is a derivative of a profit and loss account. If your assumption is I will increase my factory capacity, then obviously your fixed assets will have to go up. For your fixed assets to go up, it has to be either financed by your own internal accruals or by taking a loan. So your bank loans will go up. Your profits will add to your net worth. So it is all interlinked to your assumptions and your financial revenue projections and profit and loss projections. When you do forecasting, all this comes into picture, because why are you doing that forecasting? You are doing that forecasting either to invest in the business if it's a listed company, or to lend to a business if it's a bank proposal, or if you are the CFO of the company to make future plans, right? So that is why you're doing forecasting. Now the third point, tech and forecasting. At least from a bank's perspective, for the past 10 years, the favorite tech for forecasting has been an Excel sheet. And it continues to be an Excel sheet, at least today, from a bank's perspective. Wherein we are forecasting a client's projections and assessing his creditworthiness. Same remains the case for most of the credit rating agencies also. Now, tech in forecasting is still very, very nascent. It's not foolproof. The kind of variables which I told you and I discussed, in revenue I take 7-8 variables. Somebody else might take 10. Now, when you even in the model include all those 10 variables, within those 10 variables, the assumptions might be different for every one of you. Somebody might assume inflation at 6%, somebody might assume inflation at 4%. Right? So the model as such, the predictive model, until and unless you understand the nuts and bolts, the basics of it, you can make an Excel or AI predictive model on projections at any point of time. There will be available. But you have to define the basics and understand the basics to really have trust on the final outcome. Right? Now, I won't get into technologies because I am not a technology expert. How to use it and where do you have to think and apply your mind is what I'll be discussing. Okay? So, tech and forecasting, still very weak. Historical data, yes, we can pull out, but projections is again highly subjective, depending on your experience, your vision, your viewpoint, your mood, a lot of times. Okay? Analytical tools. Now we come to analytical tools. Analytical tools in banking, the favorite tool of banking for analysis is the CMA, a tool called CMA Excel. CMA essentially is a Excel sheet with two input sheets. One input is for the profit and loss account, one input is for the balance sheet. You normally input 3-year historical, and then you make projections for the next 4, 5, 6 years. The rest of the sheets will give you different data. Will give you a cash flow analysis, where your cash generated, where is you been utilized. It will give you financial ratios, about 40 to 43 of them, which we bankers use. It will give you the drawing power calculation, or MPBF calculation is the technical term, maximum permissible bank finance, which is used to calculate your drawing power for working capital, CC limits. And it will give you some scenario analysis. So as a employee, frontline employee, whether in credit, in sales or in risk, all you need to get, you get is that tool. You input the two sheets, you do your projections, rest, data will be available to you. Your analysis of the data is what will be critical. Okay? As far as the investment industry goes, or stock industry goes, right? The ratios, the additional ratios like a P ratio, all those technical candles and cup and handle and strangles and all those are available. When I look at investments, I am more of a bottom-up guy, a fundamental guy. So I will look at a business, its growth potential, I will look at my assessment of business 3 years down the line, and I will invest in a business as high as 40, 50 PE also, and I'll not invest in a business with 2 PE also. It all depends on my view of the business. So, fundamental analysis of a stock is something which is there in your course sir has already taught you. So, I don't need to get into it. But how tech has helped? Tech has ensured data is available on your fingertips and you don't really need to calculate anything now. Comparisons and slices and charts can be done very easily with the available data. And these are all online services which you get. Again, these are all data providing services. The analysis is yours. It will tell you whether a company has a certain PE. You can say, I want companies with less than 10 PE. I want companies with 30% annualized growth for the past 5 years. You can do short screening as such. But beyond the screening, getting to the final investment decision or your making your case, conviction key, it's investable or not. It's entirely your thought process. Okay? So tools as such, there are ready-made tools available, screeners and subscriptions available which you can use. But they will give you only historical data. Okay? We'll take the bottom two first. How AI can help in portfolio management. Now, how do you think AI can help in portfolio? Portfolio, I mean stock portfolio, right? That is what the assumption is. You tell me how. One addition. In addition to building models, that is the long-term investment model. There are a lot of short-term quant trading models which have been built up and developed. So a lot of mutual funds also have PMS funds, hedge funds have this daily quant trading desks, wherein you and me as humans don't trade. We just put in the strategy and we initiate the program trade, right? So those are the AI models which are really in vogue right now in turn the stock market. Portfolio management, it's all data aggregation. AI is overhyped, it's data aggregation at this point. There is nothing else beyond data aggregation what they're doing. But in quant trading, yes, they are building very complex algorithms. Okay, if economy report comes in this, if US market does this, then you buy long, you buy short and so on and so forth. So those are strategies. But again, those models are nothing but execution of strategies which we as humans or investors have devised or thought of. Right? So again, इसमें भी मेरा ये कहना है कि if you are going into that space, if you are really so tech inclined, then you get into algorithm writing. Otherwise, you think about strategies. Okay, if I've got to build a trading strategy, this will be my trading strategy. Right? So that is what you do.